Hello and welcome to this weekly market recap for the week ending March 14th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with all of you again this week. It's been, kind of a crazy start to 2025, a challenging start, and certainly one that we had talked about quite a bit back at the beginning of the year at our Market Vision 2025 event. That was the first week of January. Talked about the possibility we'd see an S&P 500 correction, 10%. We actually hit that this last week. We did go a little bit above the 10% correction threshold from our all-time high down to the low from last week. We've seen the NASDAQ drop about 14% from its high, and the small cap Russell 2000 has been down about 17% from its recent all-time high down to recent lows. So a lot of weakness in the market, really not a huge surprise to me. We've been talking about this throughout the first couple months of the year. As members know, I talked at the end of January about moving more and more to cash. I thought the market was signaling that we would likely have some weakness ahead, and then we'd have to evaluate that, kind of, see where we go from here. And I don't like what I'm seeing right now, to be honest. I mean, I'll go through this during the show today, but I think we continue to show signals that we're not ready to turn around back to the upside in any meaningful way. We do have a Fed meeting coming up this week. We've got options expiring on Friday, monthly options expiring, and there's been a ton of selling, so there's a lot of in the money put premium. So we could see a bounce, because of that. Maybe a relief rally if we get past the Fed, and maybe, just maybe the Fed will have something positive to say for a change, and maybe do what Europe is doing, which is cutting rates. The Fed was well on their way, and then they stopped because they're worried about inflation. We just got two inflation reports out last week showing once again that inflation came in below expectations. Personally, I think the Fed's chasing the ghost of inflation, and as a result, I think giving the market an unnecessary opportunity to drop because of a potential economic weakness period ahead, or possibly even a recession. I'll throw the word out there. When you take a look at some of the areas, some of the consumer discretionary areas, it's really easy to come to a conclusion that the market is starting to price in the possibility of a recession. And I mean, you can make arguments, I guess, in a lot of different ways. I know I followed the market for a long time, and to me, two things drive the stock market: earnings and interest rates. And the Fed has their finger on the pulse of the interest rates and the economy, and that's what drives earnings. And unfortunately, we don't have a Fed that's particularly dovish right now. We did, and the market reacted in kind back in the fourth quarter, and really starting in the third quarter. But here in 2025, the Fed's put the brakes on interest rate cuts, said they're pausing, and we have seen a lot of deterioration in many of the economically sensitive areas of the market. So I think the Fed's making a big mistake. I've said it for a while. I think cash is still king until the Fed gets it right, and I don't think they're getting it right. That's just my opinion. I've said many times, I think the folks on the Fed are brilliant people, but I think stock market is sending them a signal that they're ignoring right now, and I don't think that's wise. And we'll see how it all plays out. Let's take a look at what happened last week, and then we'll kind of go from there. I'll give you some of the signals, talk about some of the signals that I think are suggesting that we could have more weakness ahead. I don't like the bounce that we saw. We got a little bit of a bounce at the end of last week. I don't know. It wasn't very strong, in my opinion. Taking a look at the major indices last week, we had the Russell 2000 drop 1.5%. That was the best performing group. Mid caps down 2%. S&P 500 down 2.25%. NASDAQ down 2.5%. Dow Jones down 3%. And check out transportation. Now, this is one of those signals. I mean, transports, if you're going to ship more goods, or it looks like maybe more goods are going to be shipped, transports should start to take off. I mean, that's really the only thing that matters to transportation stocks. Is the economy getting stronger, or is it getting weaker? What are we anticipating? And that generally is going to dictate which way we go. And I got an interesting chart I'll show you right at the end of the show with transportation relative to utilities. And I think the signal that's being shown here over the last 2 to 3 months is not a very good one. But again, we'll talk about that a little bit later in the show. Let's move on to the sectors. Energy and utilities, the only two groups to the upside. All the other 9 sectors are down or were down. And check out the ones down here at the bottom, both consumer groups. So you want to talk about another sector, or excuse me, another signal that suggests economic problems ahead? Well, whenever you get consumer stocks down at the bottom, that's usually not a good sign of the economy. And both of them dropping more than 4% last week, with discretionary still dropping more. And that's been a theme now for quite a while. Communication services also down, healthcare, real estate, industrials. Technology had a big boost on Friday. That was the only thing that kept them from being down at the bottom for the week as well. So we did get a little bit of a boost in technology. Semiconductors had a really strong week, but they're just now approaching a key area of resistance. I wouldn't be surprised to see next week. Well, we've got options expire. I shouldn't say that, but I do think we're going to have another downturn in technology and in particular in those semiconductors. But we'll let this, let's see how this plays out this upcoming week. We do have a Fed meeting Tuesday and Wednesday. We'll see if the Fed changes its tune at all on Wednesday at 2 p.m. That's when we'll get the policy statement out. And then, Friday is options expiration. And, you got a lot of market makers. There's a lot of money on the table. Market's been going down quite a bit. So we'll see whether or not that has an impact and a possible short-term rally, maybe just to wipe out some of those net in the money put premiums. All right, keep moving on. How about the S&P 500? Well, after failing on that false breakout in mid-February, you can see been a pretty steady line. And there's that Friday bounce that we saw. But Monday through Thursday, you can see 4 filled candles, 3 of them red, 1 black, but all filled candles mean that you are closing below the open. So it's hard to argue accumulation when you continue to see the basic candlesticks filled, meaning again that you're closing below the open. That's not a sign that we're gapping down and then we're seeing a lot of accumulation during the day where you would finish up and you'd have hollow candles. So I think this is the first leg down. I think we're bouncing, or we bounced on Friday. We'll see how far we can get. I know earlier, this is coming out pretty late on Sunday evening. So I did see futures were down earlier, but that was a couple hours ago. Let me see see what they're looking like now. Still red, about what they were before. S&P down about 0.4%. NASDAQ around about a little less than 0.5%. Small caps, Russell 2000, just a little bit more than 0.5% down. But a lot can change overnight. I don't know. We'll see. I think we have an opportunity based on Friday's close that maybe short term we get a little bit of a rally, or maybe we just keep going down. Maybe the Fed throws us a bone, something on Wednesday, saying that, if we can get a couple more readings about, with inflation being below expectations or at expectations, maybe they would reconsider starting to cut again. I mean, it could just be something simple that they say like that might get some buyers coming back into this market. But I believe if the Fed stands their ground on Wednesday and says that they're continuing to watch inflation, that the inflationary pressures are still out there and they don't hint at cutting rates, I think we got another leg coming. I would not be at all surprised. I think Wall Street is pretty disappointed in the wishy-washy back and forth waffling Fed. And until Wall Street feels more comfortable that the Fed is going to focus on the economy rather than inflation, I think what we've been seeing is what we're going to continue to see, a floundering market to the downside. NASDAQ 100, pretty much same thing. You can see the false breakout to the upside and then straight down, a little bit of a rally on Friday. Not enough to get me overly excited. I mean, I did write or did talk to, I was out much of last week with another family emergency. It's been kind of a rough period for the last couple of weeks. But I did talk to John Hopkins. I looked at the market a little bit on Friday, and we had a little bit of fear that was coming into the market, which was welcome. Finally, when I'm talking about equity only put call ratio, that fear was coming in. Of course, we had the VIX getting up close to 30. So we had fear coming into the market, and a lot of times that'll help generate a bounce, even if it's just temporary. We also had 60-minute positive divergences across almost every index, and many of the sectors that have been going down were flashing positive divergences. I'll show you those here in just a minute. And then let's take a look at this. Was the IWM. You can see basically the same thing, but we were all the way up almost to 245, fell below 200. So we're getting close to a bear market in the small cap area. Again, we did see a little bit of a bounce on Friday. We'll see if it continues early into this week. But it's, again, the signs I'm seeing are be careful. I would not be trusting this as a bottom. I don't believe the bottom is in. Transports just gotten worse and worse. And this, again, this is a really good signal of what the stock market believes about the economy. And when you see the transports at 16,750 less than a month ago, and now we're at 14,500, that is a very, very steep drop. We've taken out a lot of support levels. I can't put a positive spin on that. 10-year Treasury yield. You know, if we're worried about inflation, folks should be exiting bonds. Who wants to hold a bond if inflation is going to return? But that's not what is happening. You can see over the last 2 months, 2 months plus, the yield's been going down. That means folks are buying bonds. Bond prices are going up. Yields are coming down. Why would anybody buy a bond if they're worried about inflation? So again, the signals I see in the market are that we have economic problems, not inflation problems. But the Fed is not addressing the economic problem. And until they do, I think the market's going to continue to be weak. I'm going to go into some other things here in just a minute. Just wanted to make sure everybody's aware. Over at earningsbeats.com, that's our home. If you go over to earningsbeats.com, both plural, and scroll down, we have a free newsletter. If you like what you hear on the show, I try to be unbiased. I try to be objective. I look at the charts. I listen to what the charts are telling me, not what the media is telling me, not what anyone else out there is telling me. I like to see what the price action's doing, where the money's going. That tells me pretty much all I need to know. Anyhow, name, email address, hit that subscribe button. You can join tens of thousands of folks that have joined us at our Earnings Beats Digest newsletter. It comes out Monday and Wednesday, twice a week. I think Wednesday we didn't send one out because that's when some things hit that I had to tend to, unfortunately. So we didn't get a Wednesday EB Digest out, but we should be back on schedule for this week. But check that out. I mean, it's again, it's totally free. It's usually 2 paragraphs and a chart. Talks about a lot of the things that we feel are important at Earnings Beats. Talk about earnings. We talk about gaps. We talk about relative strength. We talk about trend lines and channels and all of that good stuff. So make sure you check that out. I think you'll be able to add something to your own arsenal as far as your trading and investing go. So make sure you check that out. All right, let's keep moving on. I wanted to go into the industry groups. So this was last week's industry groups that performed the worst. So listen to this list here. We got media agencies, computer hardware. You know what that houses? Apple. Computer hardware, second worst last week, down almost 8%. Of course, Apple had a really rough week. Recreational products. What group is that in? Discretionary. How about clothing and accessories? Discretionary. Footwear. Discretionary. Home improvement retailers. Discretionary. Hotels. Discretionary. Tires. Discretionary. Travel and tourism. Discretionary. Are you getting the theme? Lots of discretionary stocks getting hit. And everyone, always looks at Amazon and Tesla because they're so heavily weighted in the XLY. And that's good reason to check those two out. But it goes a lot deeper than that. It has been a lot deeper than that. There's a lot of discretionary stocks that have been underperforming. Makes little sense if you think the economy is going to get any better. These are the areas that you would be selling if you thought the market was going to weaken and that the economy was going to weaken. So again, all of this doesn't fit the profile of re-emerging inflation. To me, it's pretty clear that the market's worried about the economy. And we got, the European Central Bank continuing to cut rates. I think they cut rates now 5 or 6 meetings in a row. And what are we doing? We're pausing. We had 3 rate cuts going. We probably should have kept them going, just like Europe, but we haven't. And as a result, check out our market and our major indices relative to the indices from around the globe. About the time the Fed waffled again, that's about the same time that all the other major foreign indices started crushing the S&P 500. So there's no question in my mind what's the problem here. And I know a lot of you have had comments talking about politics. Listen, I don't talk politics. Never have, never will. You're not going to hear me talk politics. As far as I'm concerned, when I talked about the Fed, I talked about the Fed during the Biden administration. I talked about the Fed, and I'm talking about it now during the Trump administration. Like I said earlier, two things drives the stock market: earnings and Fed policy, interest rates. And they've got control of it. The Fed has control of that. And so what they do, in my opinion, has a lot to do with what goes on in the market. And I mean, I've pointed to it many times that either their action or their inaction has caused a lot of issues in the market over the last several years. Not a big fan of Chief Powell and this particular Fed, even though I think they're all brilliant folks. I just don't think I think they're paying way too much attention to inflation. Again, there are no other signals in the market, or relatively few signals in the market that are showing that the market is worried about inflation. Anyhow, yeah, here's all your negative groups from last week. Some pretty big losses in some key areas in our aggressive groups. Now, if you look at what worked last week, got this nice bounce on Friday, kind of felt good about that. And for the week, look at what was leading: coal, non-ferrous metals, pipelines, gold mining, semiconductors. Okay, we got one. I'm going to show you the chart on semiconductors a little bit later. But semiconductors, I think, reaching a key area of resistance. We want to be careful with that group. Exploration and production, another energy area. Specialty finance, that's a pretty good one from out of the financial group. Heavy construction's okay. And then you got conventional electricity, which is utilities, aluminum, insurance, marine transportation. Where's software? Where's internet? Where's any of those aggressive areas of the market? Where's banks? Love to see the banks doing well. I mean, rates coming, the 10-year treasury yield coming down. That partly is the problem, because we stopped lowering the rates on the Fed funds rate. The Fed stopped cutting rates. So as the 10-year comes down, it's putting a squeeze on banks again. So banks are selling off, at least relative to some of these other areas. And I think that is part of the problem. All right, so here's the semiconductor chart. And this goes back, this is a daily chart, just going back 1 year. But look at this big drop. We've cleared some key support levels, especially around that 17,750 area. Went all the way down to almost 16,000, below 16.2. And then over the course of last week, 4 of the 5 days, we saw some pretty good action. Most of this is gap ups, though, if you look at it. It's not a lot of big hollow candles. Friday, a little bit. But we had a massive gap up on, this would have been Wednesday, slight gap up on Thursday, another gap up on Friday. There wasn't a lot of buying, in my opinion. And so I think part of this is a little bit of rally, a little bit of manipulation. I wouldn't be surprised to see this reverse back down either this week. And the only reason I'm maybe giving a little pause there is because we do have options expiring, and there's a lot of folks that play options. I don't know, haven't looked at it yet. I'll be looking at it tomorrow and Tuesday just to kind of see where we stand with options. But my guess is that we, down here at the bottom, beginning of last week, we had a ton of in-the-money put premium. Now, last week's jump or rebound cut into some of that, but we probably still have some left. So maybe we move up a little bit above the 20-day moving average. I certainly don't think we're getting up above the 50. That would be quite a jump, and I just don't see that coming. But maybe we get a little bit more upside because it's option expiration week, and then I expect we're going to go back down again. Travel and tourism. This is a group that was looking really good. I'm going to stretch this out a few years. Let's go 5 years on this daily chart. And I was really bullish, the travel and tourism group, in February. I mean, we had a couple that we added into our portfolios because this was a group just breaking out. Everything looked really good, and then completely has fallen apart in the last month. And this is an area that should do well when the economy's strong. Now, it looks like, with the way some of the other foreign indices are performing, that maybe we're going to get that strength in some other areas. I've said for the first time probably in about 8 to 10 years that this might actually be a good time to diversify a little bit more into international stocks. Until the Fed gets it right, until we start to see a bottom and the U.S. market begin to outperform again, I think you got to stick with what's working. And right now, with rate cuts coming in the UK and around Europe, I think you got a chance for an extended rally. I think this could just be starting over there, and you might see a lot of money rotating out of the U.S. into foreign indices based on the performance we've seen over the last few months. And again, for me, it comes down to the Fed. If the Fed's not going to be willing to cut rates, I think we're going to see money rotate out of the U.S. Computer hardware. Here's a big breakdown here. Remember, we had all these bottoms that kept holding. I kept saying, Apple, I think it's down around the 120 level or 220 level. And I'm going to show you the Apple chart in just a minute, but there's a key support level that had been holding multiple times. Well, we broke below it, and you can see that here on the computer hardware chart as well. So we had a nice little move up to test recent highs, good volume in February, and then over the last 2 to 3 weeks, it's just been straight down. And there were a lot of signals out there suggesting this. Been talking about it for a while. I've been talking about it since the end of January, that I thought the market was topping. Here's Apple. So 220, you see that level coming across here? How it's held so many times at 220. Here it held 220, new high. Here it held at 220, got back up close to 250. This time we didn't hold 220. So my guess is we're not going to get back through that 20-day moving average, which is declining and now below 230. So maybe we can bounce. Options expiring again. Maybe we get a little bit of a bounce, but I don't expect it to last. I'm not even sure we're going to bounce. I mean, it'll be interesting, but I'm just not seeing any signs yet, any significant signs that we bottomed. And I really wanted to see some rotation back into more aggressive areas when we started to bounce. We saw that on Friday. We did get a little bit of movement back into technology, like I said, semiconductors, but not a whole lot else. And that's definitely worrisome. All right, here I want to show you the S&P 500. Now, this is, as of Friday's close, you can see obviously S&P going down, but I want you to take a look at the S&P back in December, and then the S&P third week of January, maybe even into the fourth week of January, higher prices, and then one more final high, the second, well, maybe third week of February, right? Higher, high, higher, high. See how they're going up? I want you to look at discretionary versus staples, this relative ratio that I like to follow. Here's December. So here we are at the high, and here we are at the high. We come down, we go back up to this high in January, third, fourth week of January. Notice the XLY, XLP does the same thing. And then gap downs. Remember the first one, that was the DeepSeek. And then the next one, I think, was tariff related, where we had the big gap down the following Monday. And you can see that since then, on this rally back to set another new all-time high, look at what happened to the consumer discretionary versus staples. We not only went down, but we set about a 2.5-month low right at the high in the S&P 500. So you got to picture the S&P going up, but Wall Street moving all their money away from discretionary and into staples. Why do you do that? You do that because you're defensive. You want to move your money to be more defensive so that you don't get hit as hard when the market goes down. That's your signal that Wall Street's selling. If you're waiting on CNBC for someone to come on and tell you to get out, that Wall Street's rotating their money, you're going to be waiting a long time. They're not going to tell you. They're going to tell you, they're going to start downgrading all these stocks after all of the damage is done. And then when you start selling because they downgraded, guess what they're going to be doing? They're going to be backing up the truck and buying. It's the way the market works. Hate to say it, but that's the way the market works. Anyway, so do you see this ratio falling apart at the last high? I want you to look back at the end of 2021. I pulled the same chart up, and you can see right here, November, we went up a little bit higher at the end of November. And then finally, at the end of December and early January 2022, we set the final high. And you see the S&P going up, right? Well, here, back in November, this high and this high, look at the XLY, XLP going up. And then during this period, as we go up to a new high, look at the XLY, XLP falling apart, moving back down to about a 2-month, maybe even longer low. Before or while the S&P 500 setting a new high. Again, Wall Street completely rotating, taking all their money out of consumer discretionary, taking all their profits and moving it into discretionary stocks. And look at what happened afterwards. Doesn't this look a little familiar? Not only is it going down the market, but the XLY XLP ratio continues to go down. We're looking at kind of a repeat of what we saw at the end of 2021, early 2022. Now, personally, I don't think it's going to go that far if the Fed gets it right. If the Fed doesn't get it right, I think all bets are off. I think if the Fed continues to chase inflation and they do it long enough, I think they are going to throw us into a recession. And I mean, you can come up with whatever other reasons or other reasons why you think the market's going down, why we're going to have a recession, blah, blah, blah. And that's fine. I don't use politics. A lot of folks are trying to blame this. And, last 4 years, Republicans blaming it on the Democrats. Now the Democrats blaming it on the Republicans. If you study history, who's in the White House has had very little impact on the stock market. The one thing that does have a lot of impact on the stock market, though, is the Fed. And so if the Fed doesn't come off of their stance of we're fighting inflation first and still fighting inflation, and we're going to wait to fight on the economic front, again, just my opinion, I think they're making a big mistake, and I think we're going to pay for it in where the stock market goes. All right, a couple other things real quick. A lot of folks do not understand perspective when they're looking at the stock market. They're always trying to pin market weakness on something somewhere. I simply said beginning of the year, we were up against this channel line. And look at what happens when we get to the channel line, or if we happen to break outside the channel line. What I did is I connected the lows. These are two lows from panicked situations. Extreme panic, financial crisis, pandemic, two extremes. Connect that, drag that line to the top, and essentially it connects almost every high. The highs that go a little bit above are the ones that have preceded some really rough periods in the market. Now here we went right up to the channel line. So I thought we had a couple things. We were either going to just go up really slowly because we're already at the channel, top of the channel, or I thought we were going to go down. And if you were at Market Vision 2025, you know that I thought the first quarter was going to be very challenging. And I thought the S&P 500, we could see a 10% correction. We hit that last week. Now the question is, are we done going down? And personally, I don't think so. Here's the final chart I'm going to show you for this weekend. This is the S&P 500 on the top, and this is transports on the bottom. Now, what I really want to focus on here is what has happened since the middle of the fourth quarter of 2024. So if I annotated this, what I would be pointing out is what you're going to see right here. That drop from going from an all-time high, this is the transports. If you look at the all-time high where we were in the middle of the fourth quarter to where we are now, which is now at about a year and a half low, we've done this in probably about 4 months, gone from an all-time high to a year and a half low. What's changed? Fed policy. I mean, if you look at a lot of the growth versus value, and you look at the market and you look at the relationship discretionary versus staples, it all started going down anywhere from November, December into January. And that's exactly when we moved from low cutting rates to once again waffling and being concerned more about inflation than the economy. We just had an inflation report. PPI came in flat. I mean, the CPI came in basically as expected, but that was a big drop from where we were the prior month. I think that CPI is a little bit volatile, which is normally what happens when you come down from elevated inflation levels at the core CPI, from a core CPI standpoint. When you're elevated for a while, a couple years, 2, 3 years, and you start coming down, you'll go into more normal period, and then you'll get these bounces from time to time, like we saw last month. But I think it's going to come down to what the Fed does this week. I really do. I think short term, we got options expiring. So that kind of throws a little bit of a monkey wrench. Maybe we see a little crazy rally that we were not expecting because of that. Maybe there's a relief rally because of the Fed being behind us after the meeting. But I don't think we've seen a final low. That's where I am right now. So hope I'm wrong. Hope this market turns around. I hope Friday was an indication that things are going to improve. But based on what I'm seeing right now, I just don't see it. So I'm going to leave you with that, unfortunately. Have a great rest of your week. Please like our video, subscribe to our channel. That will really help us on YouTube, improving our algorithms to help build our community. So even if you're not a member at Earnings Beats, you can really help us by liking our video and subscribing to our channel. Have a great rest of your weekend, although there's not much left, and have a great week ahead, everybody. Happy trading.